Welcome. Today, we're diving into the basics of how the stock market works. If you've ever wondered what stocks are or why people invest in them, you're in the right place. The stock market might seem complicated at first, but with a simple explanation, you'll see it's not as mysterious as it appears. We'll start by breaking down what a stock actually is, why companies issue them, and how everyday people like you can become part owners in big businesses. Let's begin our journey into the world of stocks and investing. A stock represents a share in the ownership of a company. When you buy a stock, you're essentially buying a small piece of that company. This means you have a claim on part of the company's assets and earnings. Companies issue stocks to raise money for growth, research, or other business needs. Investors buy these stocks hoping the company will do well, making their shares more valuable over time. Stocks are also called equities because they represent equity or ownership in a business. Companies sell stocks to raise money they need to grow and expand. Instead of taking out loans, they can offer shares to the public. This process is called going public and usually happens through an initial public offering or IPO. By selling stocks, companies get the funds they need for new projects, hiring, or even paying off debt. In return, investors get a chance to share in the company's future profits and growth. It's a win-win situation for both sides. The stock market is a place where buyers and sellers come together to trade stocks. Think of it as a giant marketplace. But instead of fruits and vegetables, people are buying and selling pieces of companies. The stock market isn't just one physical place, it's a network of exchanges, like the New York Stock Exchange or NASDAQ, where trading happens electronically or in person. This system helps companies raise money and gives investors a way to buy and sell shares easily. Stocks are traded on stock exchanges, which are platforms that connect buyers and sellers. When you want to buy a stock, you place an order through a broker, who then finds someone willing to sell at your price. The exchange matches these orders, and the trade happens almost instantly. Today, most trading is done electronically, making it fast and efficient. This system ensures that stocks can be bought and sold quickly, providing liquidity to the market. A stock exchange is an organized marketplace where stocks are bought and sold. The most famous exchanges are the New York Stock Exchange, NYSE, and NASDAQ. These exchanges have strict rules to protect investors and ensure fair trading. Companies must meet certain requirements to be listed, which helps maintain trust in the market. Exchanges also provide transparency so everyone knows the current prices and trading activity. A broker is a person or company that helps you buy and sell stocks. In the past, brokers worked on the trading floor, shouting orders. Today, most brokers operate online, making it easy for anyone to invest from their computer or smartphone. Brokers charge a fee, called a commission, for their services. They also provide research, advice, and tools to help you make informed decisions. To buy a stock, you first need to open an account with a broker. Once your account is set up, you can search for the company you want to invest in, decide how many shares to buy, and place your order. The broker handles the rest, matching your order with a seller. After the trade is complete, you officially own shares in that company. It's a straightforward process that anyone can learn. Selling a stock is just as easy as buying one. Log into your brokerage account, select the stock you want to sell, choose how many shares, and place a sell order. The broker finds a buyer, and once the trade is complete, the money from the sale is deposited into your account. This flexibility allows investors to react quickly to changes in the market or their personal financial needs. The share price is the current cost to buy one share of a company's stock. This price changes constantly throughout the trading day, depending on supply and demand. If more people want to buy a stock, the price goes up. If more want to sell, the price goes down. Share prices reflect what investors think a company is worth at any given moment. Share prices change because of supply and demand. When good news comes out about a company, more people want to buy its stock, pushing the price up. Bad news has the opposite effect. Other factors, like the overall economy, interest rates, and global events, can also influence prices. This constant movement is what makes the stock market exciting and sometimes risky. Some companies pay dividends, which are regular payments to shareholders. Dividends are usually paid out of the company's profits. Not all companies pay dividends. Some prefer to reinvest their earnings to grow the business. For investors, dividends can be a steady source of income, especially from well-established companies. When you sell a stock for more than you paid for it, the difference is called a capital gain. This is one of the main ways investors make money in the stock market. On the flip side, if you sell for less than you paid, you have a capital loss. Understanding capital gains and losses is important for managing your investments and taxes. A stock market index tracks the performance of a group of stocks. The Dow Jones, S&P 500, and NASDAQ Composite are some of the most well-known indexes. They give investors a quick way to see how the overall market or specific sectors are doing. Indexes are often used as benchmarks to measure the success of individual investments. A bull market is when stock prices are rising and investors are optimistic. A bear market is the opposite. Prices are falling and people are pessimistic. These terms help describe the overall mood and direction of the market. Understanding whether the market is bullish or bearish can help you make better investment decisions. Many experts recommend investing in the stock market for the long term. Over time, the market tends to go up, despite short-term ups and downs. Long-term investors are less affected by daily price swings and can benefit from compounding returns. Patience and discipline are key to successful investing. Short-term trading involves buying and selling stocks quickly, sometimes within days or even minutes. Traders try to profit from small price changes. This approach can be risky and requires a lot of time, research, and attention. Most beginners are better off focusing on long-term investing rather than short-term trading. Investing in stocks always involves some risk. Prices can go up or down quickly, and there's no guarantee you'll make money. Some companies may even go out of business, making their stocks worthless. It's important to understand your risk tolerance and never invest money you can't afford to lose. Diversification means spreading your investments across different companies and industries. This helps reduce risk because if one stock performs poorly, others may do better. A diversified portfolio is less likely to suffer big losses from a single company's troubles. It's a key principle for smart investing. A portfolio is simply a collection of all your investments, including stocks, bonds, and other assets. Managing your portfolio means deciding how much to invest in each type of asset. A well-balanced portfolio can help you reach your financial goals while managing risk. Mutual funds are investment vehicles that pool money from many investors to buy a variety of stocks and other assets. They're managed by professionals and offer instant diversification. Mutual funds are a popular choice for beginners because they make investing easier and less risky. Exchange-traded funds, or ETFs, are similar to mutual funds but trade like stocks on an exchange. They offer diversification and low fees, making them a favorite among investors. ETFs can track indexes, sectors, or specific themes, giving you lots of options for building your portfolio. When you buy or sell a stock, you place an order. There are different types of orders, like market orders, which buy or sell at the best available price, and limit orders, which only execute at a specific price. Understanding order types helps you control how and when your trades happen. A market order is the simplest way to buy or sell a stock. It tells your broker to execute the trade immediately at the best available price. Market orders are fast and easy, but you might not get the exact price you see on your screen, especially in a fast-moving market. A limit order lets you set the price you're willing to pay or accept for a stock. The trade only happens if the stock reaches your price. This gives you more control, but there's a chance your order won't be filled if the price doesn't hit your target. Every stock has a bid price, what buyers are willing to pay, and an ask price, what sellers want to receive. The difference between these two is called the spread. Trades happen when a buyer and seller agree on a price. Understanding bid and ask helps you see how liquid a stock is. Liquidity means how easily you can buy or sell a stock without affecting its price. Highly liquid stocks have lots of buyers and sellers, so trades happen quickly at stable prices. Less liquid stocks can be harder to trade and may have bigger price swings. Market capitalization, or market cap, is the total value of a company's outstanding shares. It's calculated by multiplying the share price by the number of shares. Market cap helps investors compare companies of different sizes and is often used to classify stocks as large cap, mid cap, or small cap. Blue chip stocks are shares in large, well-established companies with a history of reliable performance. These companies are leaders in their industries and are considered safer investments. Blue chip stocks often pay regular dividends and are popular choices for long-term investors. Growth stocks are companies expected to grow faster than average, often reinvesting profits instead of paying dividends. Value stocks are considered undervalued by the market and may pay higher dividends. Both types have their pros and cons, and many investors include both in their portfolios. Investors can make money from stocks in two main ways: dividends and capital gains. Dividends are regular payments from company profits, while capital gains come from selling stocks at a higher price. Some investors prefer steady income from dividends, while others focus on growth through capital gains. A stock split happens when a company increases the number of its shares by dividing existing shares into more pieces. For example, in a 2-for-1 split, each share becomes 2, but the total value stays the same. Splits make shares more affordable and can attract new investors. A reverse stock split reduces the number of shares, making each share worth more. For example, in a 1-for-2 reverse split, 2 shares become 1. Companies use reverse splits to boost their share price, often to meet exchange listing requirements. An initial public offering, or IPO, is when a company sells its shares to the public for the first time. This is a big milestone, giving the company access to more capital and allowing investors to buy in early. IPOs can be exciting, but also risky, as new stocks can be volatile. After an IPO, stocks are traded on the secondary market, which is what most people think of as the stock market. Here, investors buy and sell shares from each other, not from the company. The secondary market provides liquidity and helps set fair prices for stocks. The stock market is regulated by government agencies to protect investors and ensure fair trading. In the US, the Securities and Exchange Commission, SEC, oversees the market. Regulations require companies to share important information and prevent fraud or manipulation. Financial analysts study companies and the market to provide recommendations on which stocks to buy or sell. They use data, trends, and financial reports to make their predictions. While analysts can offer helpful insights, it's important to do your own research before investing. News and current events can have a big impact on the stock market. Announcements about the economy, interest rates, or world events can cause prices to rise or fall quickly. Staying informed helps investors make better decisions and react to changes in the market. The stock market is open for trading during specific hours, usually from 9:30 a.m. to 4 p.m. Eastern Time in the US. Some brokers offer pre-market and after-hours trading, but these sessions can be less liquid and more volatile. Knowing market hours helps you plan your trades. When you place an order, it travels from your broker to the exchange, where it's matched with another order. The exchange ensures the trade is fair and records the transaction. This process happens in seconds, thanks to modern technology, making trading fast and efficient. Volatility refers to how much stock prices move up and down. High volatility means prices change quickly, while low volatility means prices are more stable. Volatility can create opportunities for traders but also increases risk for investors. Understanding volatility helps you manage your emotions and expectations. Emotions like fear and greed can influence investment decisions. When markets fall, fear can lead to panic selling. When prices rise, greed can cause people to buy at the top. Staying calm and sticking to your plan is crucial for long-term success in the stock market. Compound interest is the process where your investment earnings generate their own earnings over time. By reinvesting dividends and gains, your money can grow faster. The longer you invest, the more powerful compounding becomes, making it a key reason to start investing early. There are many myths about the stock market, like it's just gambling or you need to be rich to invest. In reality, investing is about making informed decisions and building wealth over time. Anyone can start investing with small amounts and a little knowledge. Now you have a basic understanding of how the stock market works, from what stocks are, to how they're traded, and the risks and rewards involved. You're ready to take your first steps as an investor. Remember to keep learning, start small, and invest for the long term. The stock market can be a powerful tool for building wealth if you approach it with patience and knowledge.